Welcome to our Braun-Bostich and Associates YouTube series. Today I am going to be talking about the IRS changes to retirement plan contributions going into 2026 from 2025. So just to start, workplace retirement plans is where I'll focus. So these are plans like 401k plans, 403bs, thrift savings plans if you're a government employee. So in 2025, the max base contribution that you could make was 23,500. So going into 26, that's increasing by $1,000. So it'll be 24,500 for the 2026 tax year. So be mindful of that. And if you can afford it, make sure that you make that change with your employer to have additional amounts put into your 401k or your 403b. Also, just keep in mind that you may want to consider changing from pre-tax to Roth, and this is kind of dependent on your personal situation. Just remember that with pre-tax contributions, you get a current year deduction, so your taxable income is reduced. With the Roth or after-tax savings, that's not the case, but there are other benefits to the Roth and the after-tax buckets. If you have questions on this, we can help you. But it's just something else to keep in mind if you happen to make changes to your employer plan to consider pre-tax versus Roth. The other thing that's changing in relation to the workplace plans is the catch-up contributions. So if you are 50 or older and or turning 50 this year, you are eligible for a catch-up contribution. And that is increasing from 7,500 to 8,000. So you have an additional $500 that you can put in as part of your catch-up if you meet those age requirements. Now, this is something else to be mindful of. In 2025, that was the first year of what's called the super catch-up. So what the super catch-up is if you are age 60 to 63 by the end of the calendar year, you are eligible for this additional catch-up contribution. So for 2026, that amount is $11,250 instead of the $8,000. So that's an extra $3,250 that you can put away in addition to the $8,000 plus the base of 24,500. It's pretty significant. So if you fall into that 60 to 63 range, you can put $35,750 into your workplace retirement plan. Also, like traditional IRAs and Roth IRAs, those are increasing as well from 7,000 to 7,500 going into 2026. The catch up there is only going up by $100. It was 1,000, so it'll be 1,100 in the 2026 tax year. One other thing to be mindful of is if you are a high income earner and you had been making regular Roth IRA contributions, there are income thresholds for regular Roth contributions. So, just for example, in 2026, if you file married jointly and your modified adjusted gross income is 242,000 to 252,000, that's the range within those figures. You're limited as to how much you can put into your Roth IRA and your spouse's Roth IRA. Once you exceed 252, you can no longer make regular Roth IRA contributions. So that's something to be mindful of if you're expecting your income to increase, or if it was already close to begin with to the 2025 income thresholds for regular Roth IRA contributions. We can help you with that if you have questions or if you're not sure, but it's something to just be mindful of if you were near that point in 2025. One of the biggest headlines that came out at the end of last year going into 2026 was previously your catch-up contributions, if you were a high income earner. Now, when I say catch-up contributions, I'm referring back to the extra $8,000 or the extra $11,250 if you fell into that 60 to 63 age by the end of the year. Previously, those could be saved pre-tax. Starting this year, that is not the case. So if you're making catch-up IRA or catch-up retirement plan contributions, they have to be Roth or after tax. If your income, your wages as an individual were $150,000 or more in 2025. And so basically, you're no longer allowed to get a tax deduction in the current year, 26, for those catch-up contributions. Now, you still reap all the benefits of it being in a Roth or an after-tax type of account, but you don't get the current year tax deduction, which oftentimes that's what a high-income earner is looking for. So basically, the takeaways are these are some of the changes to workplace retirement plans from 25 to 26. Also, some other things to just be mindful of, especially regarding Roth contributions and your income, that super catch up, and then the fact that if you are a high income earner going into 26, your catch up contributions can't be made pre tax anymore. So, if possible, take a look at your plans, increase contributions to the maximum if you can afford it. If not, any increase that you can afford makes a difference when it's not in your paycheck and you're putting it away. We can help you if you have any questions on how to save, how much to save. You can find us on LinkedIn, Instagram, Facebook, and our website, which is braun-bostich.com. Thanks for tuning in.